Hi, good evening, everyone. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you so much for joining tonight. Tonight, we're going to talk about private credit, which has been a topic broadly discussed over the last year or two, and used to be something that only institutional investors had access to. Now it's possible for private individuals, high-net-worth individuals, to have access to it. At StashAway, we offer access to private credit, but tonight I will not speak about the private credit solution that StashAway offers. I'm rather gonna speak about the asset class overall, and so trying to make it as educational as possible. One of the goals of tonight is speak about private credit to a wide number of people, so even people that might not be accredited investors or professional investors or professional clients with StashAway. And therefore, I'm not going to go into the details, as I mentioned, of any specific product, but rather I'll speak about the asset class. For those of you that after tonight might want to know more about a specific product that we offer on private credit, you will need to opt in if you are in Singapore as an accredited investor, if you are in Hong Kong as a professional investor, if you are in the UAE as a professional client. At the very end, I'll explain how to do that. It's quite easy, provided obviously you meet the core wealth or income requirements that each country creates, because private credit is a product that only professional investors, accredited investors, or professional client can invest in. Anyway, as mentioned, though, I'll try to make tonight as educational as possible, and rather than speaking about a single product. The idea is that I'm going to divide it into three parts. I'm going to first talk about StashAway Reserve with a specific focus then on access to alternatives and alternatives more broadly. Then I'll speak about what is private credit and why invest in private credit. I have ample time for Q&A. Please use the Q&A function that you will see as part of your screen on Zoom, and I'll be happy to answer a question. There's also a few of my colleagues in the background that might be able to answer some of your questions in writing as you ask them along the way. Otherwise, I'll take them at the very end. Okay? So let me first start from kind of a little bit on StashAway and StashAway Reserve. What you see on this slide is our full suite of products, from cash management to core portfolios, thematic, and alternatives. Now, what we started with 7.5 years ago in Singapore, and then brought to Malaysia, Thailand, Hong Kong, and the UAE are what we call the core portfolios. That's where everyone should have 60, 70, 80% of their total wealth invested. And it's a set of diversified portfolios across asset classes. We have a few variations on the topic. I'm not going to go into the details of that, but that's the core and what we've kind of built StashAway in the first place around, with the goal of helping people build long-term wealth. We then launched cash management offering, and the idea here is to help our client get more out of their cash, more than they would get in their saving account or current account at the bank. Anywhere currently from 3.3% in Singapore dollars through StashAway Simple up to 4.3% in US dollars for US dollar cash yield. As you can see, obviously, different markets have different rates because these are currency-specific products. So, for instance, StashAway Simple is in ringgit in Malaysia, in dirhams in the UAE, and in Singapore dollars in Singapore. Yeah. We have thematic offering. We have 5 themes, 4 everywhere, and one kind of a 5th one in Singapore only. And we have alternatives. And alternatives offering is what we're going to speak about tonight. In Singapore, we have the broadest offering as of today with private credit, private equity, venture capital, angel investing, and crypto. Tonight, we're going to talk about private credit. So tonight, we're going to talk about kind of what you see on the top right of this chart as part of our alternatives offering. Now, before I do that, let me talk a little bit about StashAway Reserve, because StashAway Reserve is the program through which our clients get access to alternatives. And as a StashAway Reserve clients, you really get access to two things in addition to what everyone else get access to. First, you get assigned a dedicated wealth advisor, so You have a personalized wealth advisory program, which is free, is included in the fact that you have money managed with StashAway. The big difference versus what you are used to, maybe working with banks or independent financial advisors, is that our wealth advisors are not incentivized to sell you any product. They not make more money selling you one product versus another. And therefore, what you get is really unbiased advice about both the money you have with StashAway as well as the money you might have outside of StashAway. You can do financial planning sessions where they actually will help you understand a little bit better how to think about your overall portfolios, again, including what you have with StashAway and what you might not have with StashAway. So this is the first pillar of the StashAway Reserve extra offering versus non-reserve clients, personalized wealth advisory. The second pillar is access to alternative investments. And those are the ones I listed earlier. So in Singapore is private equity venture capital, private credit, angel investing in crypto. In Hong Kong and Dubai, for now, it's private credit only. Now, there is a lot of curation behind all of this offering. It's institutional grade strategies. We only work with the best global managers. And for private credit, for instance, we work with Hamilton Lane, which is one of the largest private markets manager in the world, listed on NASDAQ. And we do a lot of work to simplify everything, to simplify access, to simplify, for the capital cost for private equity, to reduce and simplify the fees, and to make it as straightforward as possible. Because one of the issues of private markets has been historically accessibility and complexity of access. Okay. So I've spoken a little bit about alternatives. Let me kind of go a bit deeper on what is the difference between what people consider traditional investments versus alternative investments. So first of all, traditional investments tend to be publicly traded with high liquidity. They are the markets, so they're obviously correlated with the markets. They are priced continuously intraday, and they're very easy to access. And this includes cash product, it includes stocks, it includes bonds, and it includes vehicles that give you access to those instruments. So mutual funds invested in stocks or bonds, ETFs invested in stock or bonds, for example. So this is what usually people consider traditional investments. I mentioned earlier about the core portfolios, which is where everybody should have 60, 70, 80, or up to 100% of your total wealth. Those portfolios, those StashAway portfolios, are built with ETFs mostly, okay? And in some cases, with mutual funds, but mostly ETFs. So those are in traditional investment bucket. Alternative investments can be private markets or public. I'll explain that in a second. Usually are not as liquid as traditional investments, so you cannot sell immediately. Usually are uncorrelated to the markets or partially uncorrelated. They're usually not priced continuously. They're priced either monthly or quarterly. So you have a NAV, whether your holdings have gone up or down, not immediately, but every month or quarter. And usually are a bit difficult to access. Historically, they've been only for institutional investors. Today, there are some ways to get access to this. For example, StashAway offers access to quite a few alternatives investment at this point. Examples of alternative investment include private equity and private credit, which are private, obviously, but also include hedge funds, which usually invest in public markets. Now, why do people consider allocating part of their wealth to alternatives? And there are three main reasons. The first one is increasing returns. And I'll go deeper into this in a second. I'll show you numbers. But the idea is that alternatives investment should aim for higher returns than you get from your traditional investments. And that's why you want to add them to your portfolio. The alternative investment can lower volatility. And this is true for two reasons. One is that they tend to be less volatile themselves. In some cases, this is a little bit artificial, meaning it's simply driven by the fact that they're not priced daily. But overall, they are, in fact, a bit more stable. But secondly, because they are not correlated to markets, or ideally, you get alternatives that are not completely correlated to markets, they add a little bit they reduce the volatility of your overall portfolio. And lastly, broader diversification. So it will actually give you access to more larger part of the markets, and I'm going to go deeper into this in a second. And as I mentioned, because they're not correlated to traditional asset classes, they actually just help you diversify and lower the overall volatility of our portfolio. As a benchmark, institutional investors, this means your university endowments, the Harvard endowment, the Yale endowment, the Stanford endowment, or sovereign wealth funds like Temasek or GIC or Mubadala or ADIA. In general, institutional investors allocate 23% of their portfolios to alternative investments. And high net worth individuals, in my experience, many high net worth actually allocate 0%. And this is because historically it was very difficult to access alternative investments if you were not Harvard endowment. Today, that's not the case. And therefore, today it does make sense to have part of your portfolio allocated to alternative investment. In my case, for instance, I have somewhere between 20-25% allocated to alternative investments, and I think it's a proper allocation of my portfolio. Now let's look at. I mentioned returns, so let's look at alternative returns. Here I'm focusing on private equity and private credit versus their public counterparts. So on the left side you see private equity, and you can see 10, 15, or 20 years, and you can see how the extra performance has been significant, around 6 percentage points in 10 years, from 10 to 16, around 5.5 in 15 years, 6.4 to 11.8, and close to 7 percentage points in a 20 years time frame. This is 20 years up to June 2022. If you actually add, I didn't have the as clean data up to today, but if you add the last couple of years of return, actually those deltas will increase a little bit. Similarly, for private credit, compared to the equivalent public credit markets, you'll see that actually the difference is very significant. In absolute terms, it's similar, 4 to 5 points. In relative terms, even bigger, because we're talking about double returns. And again, what you see is that in the long term, so it's 10, 15, 20 years, this has been very consistent. The returns have been consistently higher and consistent among themselves. The second piece I wanted to show you is how private markets have been especially resilient during tough times. I mentioned earlier lower volatility. And so as you can see here, these are the lowest 5 years annualized performance between 1998 and 2024. So if you take the worst 5 years in a row, market buyouts, so developed market buyouts, so this is mostly US buyouts, have done plus 1.6%. This is the worst annualized performance in 5 years. Obviously buyouts target somewhere between high teens or 20-25%. So 1.6% is not good, but here we're talking about worst 5 years annualized performance. The equivalent number for public markets is minus 5.7%. Obviously, venture capital and growth are more riskier, and therefore they actually show more volatility. On credit, this is more, even more impressive, right? So where the worst 5 years annualized performance over the last 26 years has been 4.3% per annum. The equivalent public number is the leverage loan index, which has done minus 2.8%. Again, worst 5 years performance. On the real asset, you have a little bit of more of a mixed picture with natural resources and private real estate actually showing fairly negative numbers, still better than their benchmark, minus 8.2 versus minus 11.2 for natural resources, minus 8 versus minus 13 for real estate. And on infrastructure side, you actually see positive numbers, but even the public index is positive there. The point I'm trying to make is that overall, private markets tend to add some resilience to your portfolios. I'm not saying you should have 100% of your overall portfolio allocated to private markets, but it is healthy to have a percentage of your portfolio, if you are a high net worth individual, allocated to private markets. What you're exchanging, extra returns and lower volatility with is illiquidity. So in general, you're leaving on the table the ability to buy and sell today and tomorrow. You buy today, you sell tomorrow. You can do that with most private markets or alternative products. Lastly, I mentioned earlier that access to private markets enable you to get access to kind of a broader set of opportunity and therefore broader diversification. What you see here is the percentage of companies that have more than $100 million in revenues that are public versus private. And as you can see, anywhere between 83 and 95% of companies, depending on the region, are actually private. So most companies above, and here we are filtering above 100 million. Of course, when you go below 100 million, 100% are private. So above 100 million, so decently sized company to very large companies, there is a very significant portion that are private. So this is a very large market that you actually don't see at all if you only invest in public markets. Lastly, on StashAway, before we move on to zoom into private credit, as mentioned earlier, we do offer access to alternative investments. Depending on the country, you might have kind of a broader set of products or a less broad set of products. What is common across all markets that we spend a lot of time making sure that we select and curate the choice we give to our clients and work with the best managers globally. We simplify as much as possible access. We reduce minimum fees, minimum investments, and we kind of reduce significantly fees. And we have built a structure that makes it as safe and secure as it can be to invest by actually building a trustee segregated account structure to invest in the funds that we help our clients get access to. Okay, if you want more information on this, I'm not going to spend time on this tonight, but you are always welcome to reach out to our support team, or I'll give you later also the contacts of some of our wealth advisors. So let's go into the core of tonight's presentation. Let's talk about private credit. What is it? So private credit, I'm going to read what I wrote here. Private credit refers to loans and debt investments made by non-bank lenders, such as investment funds, directly to companies, typically outside of public markets. So what this means is that it's a fund that lends directly to a company. So when a company, instead of going, so the companies have three ways of getting credit. One is the most traditional, which is going to a bank and borrow from the bank. The second one, which a lot of larger companies do, is going to the public markets and issue a bond. And so that's a way to get credit, and then the bond will be traded. And the third way is to actually go to a fund and get private credit directly from the fund. Okay, so that's what we're talking about. We're talking about debt on the balance sheet of a company given by a fund. So the first question is, why would private company decide to go for a private credit manager versus a bank, or issuing a bond, public alternatives? And there is a few reasons. The first one is that private credit managers tend to have a long-term perspective, so they're long-term partners and can work very collaboratively and actually pool funds from a variety of sources if required in order to help companies continue grow, continue investing. They tend to be much faster than both the banks and public markets. They tend to be around through periods of volatility. So, banks tend to shut down and stop lending in certain periods of market volatility, and definitely public markets tend to shut down when things are a bit rocky, while private credit providers, because of their long-term orientation, they tend to actually be around through the ups and downs of the market. Public credit managers like complexity more than the banks or public markets do. And so it is possible to structure deals that might be less straightforward. For instance, a divestiture, a large company wants to carve out a part of their business and they want to fund that carve out. That's a difficult transaction to sell to the bond markets, much easier and much faster to do it with a private credit manager. And lastly, it's confidentiality. This is particularly versus the public alternatives. Nobody needs to know that the bank has, the company has taken borrowing at a certain terms with certain specifics, and therefore that's one of the reasons why some companies prefer to actually go to private credit managers. Now, private credit is a very, very, very broad word. Let me try to give you a sense of what are the various angles, the various pockets of private credit strategies that you might find. This is not comprehensive. It's a bit simplified. I'm just trying to help you understand what are the choices you might need to make if you decide to invest in private credit. And there are three things I'm highlighting here. One is looking at the type of borrower. Two is looking at the seniority of the loan. And three, looking at the financial condition of the borrower. So let's start from the type of borrower. You can look at type, you can segment type of borrower by size of the company. Is it a very small company? Is it a medium-sized company? Is it a very large company? By the ownership structure of the borrower. Is it a private equity backed? I'm going to talk about private equity backed in quite a bit of detail in a second. Or is it entrepreneur owned? And obviously, this changes the type of sophistication that you're dealing with as a private credit provider. Is it a business, or is something that has underneath a real estate investment or infrastructure investment, which obviously creates different type of risk and different type of profiles? And is it an asset-backed business? So you will actually find private credit strategies that invest in credit card receivables, for example. So you're not giving money to individuals, but in practice, you are getting exposure to individuals' credit card receivables. And so you might want to, when you invest in any private credit fund, you want to understand exactly what you're doing here. The second angle or the second lens you want to use to understand the type of asset you're investing in is the seniority of the loan. And this is maybe the structure I'm talking about here is more specific to kind of private equity backed type of transaction. What you see on the right side is first lien, second lien, mezzanine debt, preferred equity, equity. This is a typical capital structure of a sophisticated balance sheet where you have, again, equity, you have preferred equity, you have mezzanine debt, second lien, first lien. This goes from the top is the less risky, the first to get paid out, and the bottom, obviously, equity is the residual value. In practice, what it means is that in a downside scenario, when the company doesn't do well, the first one to get wiped out is equity, then there is preferred equity, then there is mezzanine debt, then there is second lien, then there is first lien. So in order to lose capital on first lien, the company needs to really, 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 really lose all of its value. In some structures, you don't have first lien and second lien. You have unitranches, which in practice means one tranche that sits above any mezzanine or any other non-senior debt. I'm going to talk about this in a bit more detail later. As I mentioned, I'm going to speak about LBOs, leverage buyouts, therefore private equity-backed transaction, and what the private credit role is there in a second. The third lens is the condition of the borrower. So are the loans performing, which means the borrower is paying the interest that needs to be paid. It's not breaching any of the covenants. Usually there are a bunch of covenants in this type of contracts, which means in practice there are some KPIs that needs to be met by the company. For example, it can be a growth KPI. The company needs to grow at least 10% year on year, or it can be a ability to kind of a cash flow generation KPI. Is cash flow at least 2x your interest payments or whatever it is. So those are covenants that are they need to be met. If they're not met, the loan is become non-performing. If it's non-performing, it can be in what is called stress, which means the company is under stress, but still not in a concerning situation. It can go in distress. And when it goes in distress, the investments can provide either control of the company, in which case you're going for equity type returns, or non-control. You remain a debt holder. Okay, and that's why obviously when you take control in practice, you are taking equity risk at that point for a distressed company. While non-controlling means that actually there is still equity value in the company, and therefore, the bond or the loan is distressed, but it's not at the level of distress that is wiping out complete value of equity. I hope I made some clarity, because I think this is a very important point to understand, because people talk about private credit very broadly, and as I'll show you in a second, returns expectation obviously will differ a lot depending on the type of risk you take. And so, as usual, when you think about returns, you need to think about risk as well. And a lot of people talk purely about returns, but it's important to understand risk. And as you know, at StashAway, we like to actually speak about risk first, and then think about returns as a second piece. So, for example, and this is illustrative, what returns do different strategy target? So when you look at senior debt, which is the kind of a first lien, second lien, and unitranche I mentioned earlier, we're talking about anywhere between 5 and 11% target US dollar returns per annum. These returns grow as you take more risk with special situations, with mezzanine, with distressed, and with restructuring. Restructuring is when you actually take equity control, and so you're targeting private equity type returns. Obviously, this is intuitive. The more risk you take, the more expected returns go higher, the more volatility you will have. Yeah. I personally believe there is a incredibly high risk reward proposition at the higher level here when you go for senior debt, getting 8-9% per annum on the most senior part of the balance sheet of a company is actually, I think, a great risk reward profile for investors. In terms of size of the market, what you see on this slide is this is focusing on leverage buyout. So this is private equity-backed transactions. A leverage buyout is when a private equity fund, decides to buy a company, and let's say they want to buy a company for $100, and they decide to buy the company with $50 of equity, so $50 coming out of their funds, and they want to get $50 of debt, of credit. And so they can either go to a bank, or they can go to a private credit provider to actually fund those $50. As you can see, in the last 5 years, the percentage of transactions that has been funded by private credit providers has increased from around 60% 5 years ago to around 80-85% over the last couple of years. This tells you that there is kind of a growing market here, and even if there is more and more investors in private credit, there seems to be quite a lot of space to grow from a kind of volume perspective. In fact, what you see here actually tells you this even more clearly. On the left side, you see the delta between the buyout dry powder. That's the line at the top. So this is in practice the money raised by private equity that is not being deployed yet. So this is what is called dry powder. And at the bottom line is the credit origination dry powder. So this is in practice private credit dry powder. And as you can see, there is a gigantic funding gap. What this means is that there is a lot of space for private credit to grow. What you see on the right side is actually an additional lever for private credit growth, which is that while private equity doesn't get refinanced, I mean, in order to get refinanced, there needs to be a sale, a private equity selling to another private equity. Private credit transaction usually have a term, 4 to 5 years usually. And so you have a maturity at which the private credit transaction needs to be refinanced. And so you can there is the chance for another transaction. What you can see here is that there is kind of a wall of refinancing due in 2028 with $500 billion US. And so obviously funds that are being raised now or that are investing now actually have in front of them, on top of new primary, also a little bit of secondary coming. These are performing loans. So we're talking about good loans. Okay. Now, I mentioned a couple of times private equity, private credit, leverage buyout. Let's look at the two asset classes separately. And as I mentioned, in Singapore, we offer access to both. And I think it's actually good for people to have exposure to both. Obviously in different, looking at them as different parts of your portfolios. So private equity offer higher risk, higher returns than private credit. Private credit is a low risk asset class, low return. It's debt and equity. And so it's quite intuitive. In terms of numbers, the expected returns on private equity is 20% plus, while private credit, as I showed you earlier, range 5 to 15% depending on the strategy. When it gets closer to 20, you're really taking equity risk. So it's maybe you call it private credit, but really you're taking an equity risk. From a distribution and liquidity perspective, private equity usually have irregular distribution. Sorry, there is a typo on the slide. Usually have irregular distribution. So that it takes a bit of time. If you look at the duration as well, it takes 5 to 7 years to actually break even, so get your investment back, and then the following 5 years you will get the full money back. While with private credit you have regular distribution because companies pay interest to the private credit fund, and as I mentioned earlier, for a first lien that today you can get anywhere between 8 and 10% per annum on a recurring basis, on a monthly or quarterly basis. And there is a duration. There is a 3 to 5 years maturity, which kind of gives a shorter timeline. So obviously is significantly more liquid. Private equity does not have is the residual claim on any asset. So in practice, equity is the first part of the cap table to be wiped out in case of a problem. And that's why the expected returns are higher, while private credit is more senior, and depending on where you are in a stack of private credit, if you're mezzanine, you are somewhere in the middle between equity and credit. If you are a first or second lien, you are high in the total stack. And then from a fee perspective, private equity tend to have a bit higher fees than private credit, also because it requires a bit more work from the private equity firm in terms of managing of the company. The private credit is a debt provider, so it's a bit of a lighter touch. As a synthesis of this, private credit delivers a low risk, shorter duration, higher cash yield compared to private equity. Private equity has higher risk, higher return, less liquidity. Now, let me actually give you an example. And this is going to be, for those of you that might be experts, might be a little bit too simple, but let me try to simplify for those of you that might actually not be expert on the topic. So let's say that there is a private equity house that wants to buy a company and buys the company for $100. And they decide to fund this purchase with $40 of equity. So this is $4 coming out of the private equity fund, $20 of junior debt, let's call it, what I called earlier mezzanine, for example, and $40 of senior debt. And the senior debt is provided by a private credit provider and is negotiated to be at 8% interest rate. Okay. 5 years later, let's say that the company did well and is now worth $200. And so the senior debt will have received 8% per annum over 5 years. So 8% of 40 is 3.2 times 5, that's $16. So they will have been received $16 in interest. And so after 5 years, you get also the $40 back. So in total, you receive $56 out of your 40. So you made 1.4x returns, or 8% per annum over the course of those 5 years. The junior debt will have received, maybe 10 or 12% per annum. Let's call it 12%. So, a little bit more debt. So let's say 10% for simplicity's sake. So it's $2 per annum, $10 in interest. And equity will receive the residual value. So it's $200 minus $60, 40 plus 20 minus 60. So it's $140. So equity has done a very nice 3.5 times return from $40 to $140. This is a good case scenario. And as you can see, the leverage provides actually extra returns. If the private equity fund had funded 100% with equity, they would have only made 2x returns from $100 to $200. Because they put leverage on top, they made 3.5x return from $40 to $140. Okay? Now, there is also a bad case scenario. Let's say that actually the company gets sold 5 years later for $50. So, it's half of the value it was purchased from. What happens is that the senior debt gets repaid fully. So the returns on senior debt are still 1.4x, exactly the same as in the previous case. Exactly the same $16 plus exactly the same $40 repayment. The junior debt gets partially discounted because there is only $50 in total. 40 go to senior debt. There's only $10 left. And so $10 go to junior debt and 0 go to equity. So the equity gets completely wiped out. Junior debt gets 0.5x returns plus the interest they have received over the course of the 5 years, assuming there was interest paying. In some case, mezzanine is actually not interest paying. And the senior debt will have received all the interest and therefore will have made the exact same returns. Now, in order to kind of get less than the $40 or lose capital on the investment, the total value of the company in this specific example need to go down to $24, right? Because in practice, it means you get $16 of interest over the course of the 5 years plus $24. It's $40 you put in. So the company need to have lost 3/4 of its value in this specific case in order for private credit providers to actually lose a single dollar on their investment. That's why what I said earlier, sitting on the senior debt side of the cap table and getting 8, 9, 10% returns actually is, I think, an extremely valuable proposition from a risk-reward perspective. Okay, I hope I made some clarity over kind of what is private credit, and I went a bit deeper into the bigger part of private credit, which is kind of financing leverage buyouts. But hopefully I also gave you a bit of a broader framework to think about the asset class. Now, let me deep dive into why investing in private credit. As a reminder, if you have any questions, there is a Q&A function on Zoom that you should be able to get access to. You can ask the question there. As I get to the end, I'll try to address all the questions. So why investing in private credit? First of all, I mentioned it earlier, private markets in general, alternatives in general, help improve efficiency of portfolios by both reducing volatility and increasing expected returns. Let me run you through this example. So let's start from the bottom right. The bottom right, you see a pie with 40% bond, 60% public equity. It's a classic 60-40 portfolio that targets 7.5% total annualized returns and has a standard deviation, a risk of 6.3%. Okay. Now, if you add a little bit of private credit and a little bit of private equity, so for instance, you go from 40% bonds to 36 bonds and 4 private credit, actually you can see you move top and left, which means you have more returns moving up and less risk moving left. And if you move all the way here, where your 40% bonds is now 28% bonds and 12% private credit, and your equity is now 42% public, 18% private, your returns have actually increased quite significantly, close to 2 percentage points, from 7.5 to 9.5, and your risk have actually declined 5 percentage points from 6.3 to 6%. So this is actually a very significant improvement in efficiency, mostly on the return side, as you can see, but also, reducing volatility and increasing diversification. This is obviously the most important reason to consider alternatives in general, private market in general, but specifically here we're talking about private credit as an incredible good source for improving your portfolio. For example, in my portfolio, I actually have 15% of my overall net worth is in private credit right now, and I think it's a good allocation. Now let's deep dive into returns for private credit specifically. So what you see on this chart is IRR of private credit in the last 20 years, 22 years to be specific, compared to its private market equivalent, which is the Credit Suisse Leveraged Loan Index. So the blue square is diamond, actually, sorry. The blue diamond is the returns of the public market equivalent, the Credit Suisse Leveraged Loan Index. And as you can see, it's actually quite good numbers. This is anywhere between 5 and 10% in a given year. But if you compare it to the golden numbers, it's actually below that, except for a couple of exceptions in 2005 to 2007. And the golden is the average returns for private credit. If you only take first and second quartile private credit, actually the blue diamond is always below. So consistently over the last 22 years, private credit has overperformed versus public credit markets. And this is an important piece to think about, okay? If you compare private credit to other private markets, you will see that actually is the one that has the least variability of return, the most consistency. So what you see on this chart is for private equity, both buyouts and venture capital, private credit and real estate investments. What is their range of returns over the last 20 years across down markets, or when kind of markets were negative, as well as up markets. And as you can see, buyouts, as I mentioned earlier, in their kind of worst years, actually they still making money, but with quite a bit of variability between what is the lowest kind of a side on down markets, anywhere around the 2%, and kind of the best years where you actually get above 20%. Private credit, as you can see, actually is extremely stable, always around the same 5 to 15% range when you go kind of from the bottom to the top. Obviously, this depends a little bit on the risk taken, but if you only zoom in on LBO private credit, you'll see the actual returns are in the 6 to 11, 12% per annum. So it's extremely, extremely consistent. Now, let's look quickly at where we are today from an environment perspective. So as you probably know by reading papers, at this point, rates are predicted to stay higher for longer because inflation is predicted to be stickier. And I think if you follow the news over the weekend, Trump has started his tariff war, and that is believed to be inflationary in nature. So I guess this expectation might actually go a bit higher after the news of the weekend. But anyway, why this matters? So this is in practice the 3 months interbank lending rates. Why this matters? Because private credit usually has variable rates. So the way they are priced is a spread on top of a, could be SOFR. And so if, for instance, you price today a private credit deal and you charge 500, you agree on charging 500 basis points on top of SOFR, it means that you will actually get around kind of 9.5%. And if this forward curve actually becomes reality, it means that a year, 2 years from now, that number will be around 70 bips lower than that at 8.7%. So the fact that rates are predicted to stay higher for longer means that the absolute returns you're going to get from private credit will continue to remain quite fat. Obviously, from a relative return perspective, this doesn't matter, meaning that when you compare private credit returns versus other fixed income returns, that spread is what matters. It will move up and down and in tandem, but the spread will continue to be 500 basis points or 450 or 600, whatever the number might be. And the numbers are more or less what I just tell you for first to second lien. Yeah. Second piece that is important to take a look on is default rates. And as you can, this is last 20 years. And as you can see, the average default rate, long-term average is around 2%. This is actually not just first lien. This includes all kind of senior debt. First lien is actually going to be less than 1%. And as you can see, right now, we actually are below average. So, and trending lower, actually, so not trending higher. As you can see, there has been one moment over the last 20 years where default rates went higher, which was around, obviously, the 2009, 2010 global financial crisis. This is the moments where you actually see the quality of the credit portfolio. This is where it's important to work with the right managers, because those are the moments where actually there can be a big difference in terms of the default rates you experience. But obviously, for an asset class that performs 8, 9, 10% per annum, having a 1 year over in 20 years where you actually lose 8 or 9% is, I guess, a risk that is potentially makes sense given the return profile of the asset class. So I hope I gave you a little bit of color on this magic private credit world. If you want to know more, we will have a deep dive session with the portfolio manager of the fund that we currently have on StashAway on the 20th of February. Unfortunately, for those of you that are not in Singapore, this is actually going to be in person in Singapore. The catch here is that you can only participate if you are a verified accredited investor in Singapore. You will not participate if you're not a verified accredited investor in Singapore. And you will receive the address once you verify. And this is for regulatory reasons. Now, how easy it is to verify as an accredited investor or a professional investor in Hong Kong or a professional client in the UAE vary. So you just need to reach out to our customer support team to opt in. You need to opt in as an accredited investor or a professional investor. We will ask you documents showing that you actually meet the criteria, which I'll show in a second, and then you're done. Now, what are the criterias? They're usually driven by either your income or your net worth. In Singapore, it's either based on annual income over 300,000 Singapore dollars, or net financial assets over 1 million Singapore dollars, or net personal assets over 2 million Singapore dollars. Sorry, I missed the number here, 2 million, of which primary residence can only be no more than 1 million. So in practice, I mean, it goes back to net financial assets of at least 1 million Singapore dollars. In Hong Kong is net financial assets of at least 8 million Hong Kong dollars. In the UAE, it's net personal assets of more than $1, excluding your primary residence. And either you are an employee of a regulated financial institution, or you can prove that you have experience and understanding of financial markets. Okay. Again, very easy to go through this. Just reach out to customer support, and my team will be able to help you. And as part of that, I'm sharing here the contact details of some of our wealth advisors in Singapore, Hong Kong, and in the MENA region, the UAE. They will all be able to help you understand more about the asset classes that we offer, understand more about private credit, and help you opt in as an accredited investor, a professional investor, or a professional client. And obviously, if you decide to invest in any of our products, including private credit, you'll be able to do that. All right. Let me check if there is any question. Zoom. Oh, here it is. Oh, sorry, 1 second. For some reason, Zoom is not showing me. Here it is. Okay, sorry for that. Okay, I have a few questions. I'm just gonna go one by one through each of them in order in which they were asked, and hopefully I'll be able to answer all of them. From your investment experience, I'll read them loud. From your investments, have you seen or experienced capital gain or losses in private credit? Specifically, in the current macroeconomic environment, what factors could fundamentally alter the private credit investment and cause significant value loss? And what strategy can mitigate these risks? On the flip side, where do you see opportunities for growth in private credit going forward? What factors could enhance the value of private credit investments? So this question was asked at 7:10, so I hopefully I answered most of it already in the following half an hour. But let me kind of summarize my perspectives. So, as I showed you, in the last 20 years, there has been one moment in time where the broad market of private credit have experienced significant defaults, which was 2009 and 10. But if you take any 5 years periods, it has never returned less than, if I remember correctly, 4.5%. So, you don't need to have a 20 years time horizon. You just need 3 to 5 years in order to be able to see positive, significant returns. Depending also, there is obviously I'm talking about a specific part of private credit right now. I'm talking about kind of senior debt in buyout transaction. It becomes different if you start investing in mezzanine, or if you kind of move down the cap table, and it becomes obviously can become more risky. Where do I see opportunities for growth in private credit going forward? As I showed earlier, the market is expanding strongly. There is more people that are invested in private credit, but there's also significantly more, a lot of significant opportunities out there, especially in the LBO market, the leverage buyout market. Perspective is that I think my personal perspective is that it is an asset class that high net worth individuals should have in their portfolios. What could happen in the next few years if it becomes more and more popular, returns might kind of reduce, expected returns might reduce a little bit, but I think we do have a few years left, at least. Right now, we don't see that happening, right? The returns have been actually very consistent across the last 2 decades. And actually, the returns I've seen personally are in line with what, the best that we have seen over the last couple of decades. So I don't see that happening, but, obviously, the more money comes into the asset class over time, that might have an impact on overall expected returns. How will tariffs impact private credit? So I hope I answered the first question. This is the second question. How will tariff impact private credit? There's no direct impact. In general, private credit is influenced by the broad economy in a few ways. Let me maybe highlight 2. One is, if interest rates remain higher, your absolute returns will be higher than if interest rates go lower, as I showed you earlier. And the reason is that, and again, I'm talking about kind of a LBO's transaction. The reason is that those are priced in a variable manner with a spread on top of SOFR or whatever other benchmark. Therefore, if the benchmark remains higher, the absolute returns are going to be higher, as I showed you earlier. If a private credit fund agrees on a 500 basis point spread on SOFR, and SOFR is 4%, the total interest is 9%. If SOFR goes from 4 to 3%, then your total interest will go from 9 to 8. So tariffs are inflationary in nature, which means that will not allow central banks to cut rates as fast as people expected maybe 6 months ago. And that actually will be advantageous for real absolute returns for private credit. The flip side is that where private credit might suffer is if we enter a recession, and therefore if there are default events. And that's when you want to be on the right part of the cap table. You want to be in the first lien. You want to be, as senior as possible. But in general, obviously, negative economic, like a tough recession, might send some companies to default on their credit, and therefore, that obviously will have a negative impact on, in general, returns for credits. And in this specific case, that's where it becomes very important that you are at the right level of seniority in the cap tables. That's why I think it's very important you don't just look at returns, but you look at risk at the same time. This is true for every investment you ever make in your life, and obviously is also true for private credit. If risk-reward metric for senior debt is so interesting, can you expand further on why traditional lenders, the banks, are exiting this space, or at least not showing up sufficient size to meet the demand for capital? Why is this asset class only getting traction recently? It's a good question. So the reason why the asset class got traction over the last decade or so, and so it's not super recently. So it's actually, become very large over the last, I would say, 15 years, in 2008, 2009. And the reason is that with the global financial crisis, more regulation has been put on the banks in terms of capital requirements to protect their the balance sheet, especially the kind of retail depositors, and that made it expensive for banks to manage the loan books. And that's why some banks have exited the space, some banks have simply less appetite for risk, and there is therefore a set of companies that actually either do not have access to credit through the banks or don't have the patience to wait for the banks to go through the process. While private credit managers can be much, much faster, especially, again, as I mentioned, if you are a private equity manager, you want somebody that understands your language, that can kind of move fast and kind of bid, help you bid in time. You usually have an auction happening, and that's when obviously a private credit partner will be a better partner than a bank. Hopefully, I answered your question. Will the presentation slides be shared with the attendees? No, we don't share the slides, but you can ask our team to get the recording of the presentation. So just send an email to either support or to your wealth advisor, and I believe we'll be able to share the recording. So Arjun is asking, does StashAway offers access to evergreen private credit funds allowing for more periodic liquidity? Yes, but I can't tell you much more than that. So the short answer is yes. If you opt in as an accredited investor, we can actually go, we can tell you everything about what we offer. There is a question on how long is the average maturity of private credit. So the average maturity, so the terms for LBO's transaction credit is usually 4 to 5 years. In reality, refinancing happens faster than that, on average every 3 years. And what that means is that on a given year, between your 10% interest rate and kind of 33% refinancing, around 40% of the fund, 30 to 40% of the fund gets liquidity. So that's why it's significantly more liquid than private equity. And that's why also, there was a question earlier on evergreen private credit, kind of semi-liquid private credit funds. That's why it's easier to set up semi-liquid private credit vehicles because of this liquidity coming much more often, in much more substance than on private equity. One more question. What is the possibility that I will lose all of my invested funds? So obviously it depends on which vehicle, which fund you invest in, and I can't speak specifically about any right now. It depends on the risk you take. As in every investment, there is a risk you're taking when you make an investment. Returns don't come for free. Returns are either given to you, or usually they're given to you for two reasons. One is that because there is a time value of money. You give away your money for some time, and two is because you're taking a risk in giving away the money. So there is a risk-free rate, which is just time, and then everything that is on top is the risk you're taking. So there is a risk. Now, if you invest in a diversified fund that invests at the right level of seniority, I would say it's very, very. I mean, I can't speak about funds specifically. It's very unlikely that you're going to lose all of your investment funds. I showed you the default rate for the industry overall. So if you use that as a proxy, it's not something that you expect to happen. I suggest that if you're interested in investing in private credit, you opt in as an accredited investor, and you can actually ask this question specifically on the fund that we market, and then we can answer in a very, very specific way, showing kind of historical default rates, etc. It looks like I went through all of the questions. I'll wait for another 30 seconds to see if there is any other questions. Otherwise, we're fantastically on time. It's been exactly 1 hour. And so I want to thank everybody for logging in and participating. If you have any other questions, you know how to reach us. And I want to thank my team who's been helping in the background. Thank you so much. And I hope to see many of you in Singapore when I will talk to Brian from Hamilton Lane, and we'll go into much, much, much deeper detail on a specific fund. Okay. Thank you so much for joining tonight, and have a good night. And for those of you in the UAE, have a good afternoon. Bye bye.